Alarming situation. Silver crashed to 41%, 52.63 million ounces against 81.73 million. Let those numbers sit in the back of your mind as you watch the ticker today. That is not a forecast. That is not a conspiracy theory from a corner of the internet. That is the live, published, official CME Group warehouse data as of March 9th, 2026. And what it reveals about the silver market right now should be the only thing on your radar. In the March 2026 COMEX delivery cycle, physical demand has surged to 52.63 million ounces on first notice day alone. Meanwhile, the total registered silver inventory, the metal legally designated and ready to be handed over, stands at just 81.73 million ounces. Do the math. That is 64% of every deliverable ounce in those vaults spoken for in a single contract month, 1 month. And those numbers are from yesterday. Welcome back to Crucible Markets. Now, some of you are here because you saw the detonation in January. You saw silver touch $121 and then collapse to 41% in hours. You were told it was a correction. You were told the squeeze was over. Today we are going to look at the source code of that crash, the engineered margin hike from 15% to 18%, and why the vaults are still emptying despite the managed demolition of the paper price. We are going to look at why the silver vaults are down 66% in 6 years, and what happens when that number hits zero. Drop Crucible in the comments right now. It signals you are here for the data, not the drama. Let's go into the vaults. To understand why 81.73 million ounces is the most dangerous figure in the precious metals complex, you have to understand the violence of January 29th. The story of silver in 2026 is not a standard bull market. It is a detonation followed by a scramble, and we are currently in the middle of that scramble. On January 29th, silver touched 121.67 per ounce, an all-time nominal high. Silver had surged 68.5% in the single month of January alone. It was a vertical ascent that threatened the entire solvency of the bullion banks. The short stack was being incinerated in real time. Then, within 30 hours, the price collapsed to $71.67, a 41.1% drop from peak to trough in less than a single trading session. The mainstream financial press fumbled the narrative. They called it retail exhaustion. They said the meme traders went home. They didn't look at the CME rulebook. In mid-February, the CME Group raised margin requirements from 15% to 18%. For the uninitiated, a margin hike is the exchange's nuclear option. It forces traders to put up more cash to hold the same position. If you don't have the cash, you're liquidated instantly. That single action triggered the leverage unwind. It wasn't a change in physical supply. The vaults didn't suddenly fill with metal. The margin requirement changed, the leverage longs were liquidated, and the paper price was destroyed. But here's the part they didn't account for. After a 41% crash, silver is already back above $89 and climbing. Why? Because the physical demand is not price sensitive. A hyperscaler building an AI campus or a defense contractor building hypersonic guidance systems doesn't care about a margin hike. They need the atoms. The paper shorts bought themselves time, but they didn't buy themselves a single ounce of metal. Oh, let's zoom out. The registered silver inventory on the COMEX has fallen 66% in the last 6 years. This isn't a glitch in the data. It is a structural liquidation of the Western silver reserves. In 2018-20, the vaults were flush. Today, they are a hollow shell of their former selves. Why has this happened? Because the world has moved into a 6th consecutive year of a structural supply deficit. The Silver Institute published its 2026 outlook on February 10th, a projected shortfall of 67 million ounces. When a market runs a deficit of that scale for 6 years, it has to draw that silver from somewhere. It draws it from the ETFs. It draws it from the COMEX. It draws it from your hands. Mine production is projected at 820 million ounces, up 1% year on year, but it is being overwhelmed by a demand profile that has fundamentally shifted. Physical investment is forecast to rise 20% to 227 million ounces, but the real driver is the industrial singularity. Data centers, AI infrastructure, and liquid cooling systems require silver in quantities that were simply not being modeled into forecasts as recently as 2023. AI buildout is now a structural, long-term, price-insensitive demand driver. Layer this on top of China's export controls. On January 1st, 2026, the Chinese government implemented strict controls on refined silver exports. This was the silent kill shot for Western exchanges. Before these controls, when prices diverged between New York and Shanghai, metal would flow through arbitrage to rebalance the system. That mechanism is now broken. The Shanghai Gold Exchange, SGE, currently shows a persistent premium of $8 to $13 per ounce over New York. The metal is locked inside Chinese borders. The COMEX is now absorbing the consequence of losing an entire continental supply corridor while its own vaults sit at 66% depletion. The math is not just bad, it is terminal. When the CME Group hiked margins from 15% to 18% in mid-February, they knew exactly what they were doing. It was a managed demolition. By forcing a 41% crash in the paper price, they attempted to discourage the delivery demand that was threatening to empty the registered vaults entirely. Now think about the logic of the institution. If silver is at $121 and everyone wants their metal, the COMEX breaks. If you crash the price to $71, you shake out the speculators and you hope, you pray, that the industrial buyers will take a cash settlement instead of the metal. You offer incentives to settle in dollars rather than silver. This is financial engineering at its most desperate. But the data from March 9th tells us the engineering failed. A single-day report from COMEX warehouses showed a negative adjustment of 3.3 million ounces in the registered category in one trading session. That is institutional actors pulling metal as fast as the system allows. They didn't take the cash. They didn't take the incentives. They took the silver. The bullion banks with the deepest short exposure, the names you know, HSBC, UBS, Barclays, are also the primary dealers in gold. If a silver delivery failure triggers a loss of confidence event, those institutions face forced liquidations across their entire book. The cross-contamination risk between silver and gold is no longer theoretical. It is structural. Gold set an all-time high of $5,180 in January and is currently trading within 8% of that peak. The system is redlining, and the margin hikes are showing diminishing returns. You can hike the margin to 50%, but if there is no silver in the vault, the paper price is just a number on a screen. We don't operate on conviction alone at Crucible Markets. We operate on data. So let's look at the bear case. Analysts like Marko Kolanovic have suggested silver could trade back toward $50 later in 2026. His argument isn't based on supply, it's based on market structure. He argues that moves like the surge to $121 attract speculative capital, meme traders who panic and liquidate at the first sign of trouble. He points to the 15% to 18% margin hike as the proof that the exchange can and will break the momentum of the market. And he's right, the exchange will fight. They have the margin hammer and they aren't afraid to use it. But what the bear case misses is the floor of necessity. Scrap volumes are up 7% and jewelry demand is down 9%. That is demand destruction. But AI infrastructure, semiconductors, and electric vehicles are not jewelry. They are the core components of the 21st century economy. A defense contractor building a missile guidance system isn't going to stop buying silver because the price is high. They are going to buy it at any price because without it, the missile doesn't fly. The iShares Silver Trust, SLV, is currently facing renewed scrutiny over its sourcing of physical metal. The Sprott Physical Silver Trust is trading at a premium because investors are seeking guaranteed physical backing in an environment where the guarantee chain from paper to physical is under visible strain. When 65.5 million ounces of ETF holdings look for redemption simultaneously against 81.73 million ounces in the COMEX, the math simply does not resolve quietly. That is not a prediction, that is arithmetic. March 10th, 2026. Silver is at $89 and climbing again. The margin hike crashed the price, but it didn't fix the insolvency. The vaults are still emptying, the deficit is still 67 million ounces, and the paper wall is thinner than it has ever been in the history of the exchange. The engineering is impressive, but it has a physical limit, and that limit is approaching in the next 90 days. Every ounce that leaves the registered column is one fewer ounce standing between the current pricing structure and a reckoning that the mainstream media is not prepared to cover. I want to hear from you. What are you seeing at your local coin shops? Are the premiums for physical bars still $10 to $15 over spot? Are you seeing out-of-stock signs? Give us the boots on the ground data in the comments. We map the structure together. Hit the subscribe button. The signal will move if the platform moves. Stay locked in. Stay skeptical. Stay prepared. And most importantly, stay sovereign. I'm out.